Nitesh Sharma of PhillipCapital is now with us. Nitesh, the PAT is not a clean number. There is asset impairment which is there for JLR. What's your call on EBITDA, which is 6,522 crores, about 8.5%, sorry.
Yes, hi. So prima facie, it looks like to be a bit weak in terms of what we were expecting. We would have to look at the clean EBITDA margins for JLR. The reported margins at 7.3% looks like it's way off our estimate of 11.5%. We would like to await management commentary as to how much has been impaired and what sort of one-off is there during this quarter.
Hi Nitesh, this is Nantara joining me for the New Delhi studio. So if I were to take out the forex loss out of the equation, that exceptional loss that has come in, the forex loss incidentally at 171 crore rupees. But if you look at the performance, at least with the terms of sales, would you say that is as per estimates, because that might give an indication for the volumes as well? Bharat Girani, if I could come to you now. I think Nitesh can't hear me. First cut analysis of Tata Motors is obviously one very big exceptional item of almost 27,000 crore rupees. What do you make of the numbers?
Yeah, so numbers, the loss seems to be very high, and we'll have to exactly see the nature of what impairment it has taken. But if you adjust for that, then the numbers I think are pretty much in what line with what the street was expecting.
What is the EBITDA number on a consolidated basis that you were expecting?
EBITDA at the console level, we were expecting about 7,600 crore.
6,500 crore. Now, can you tell us your estimate?
For the console thing, we are expecting 7,700 crore, and it is 6,500 crore seems to be on the lower side then.
Right. And if I look at the JLR margins, EBITDA margins, which are at 7%, don't you think that's a number which is very weak? 10-11% is what the bet?
It is weak, and the consensus was expecting about 10% kind of a margin. So definitely the number seems to be on the lower side.
Right. I have a N. Chandrasekhan, chairman of Tata Sons, who has commented on this. And let's start with the JLR bit. In JLR, the market conditions continue to be challenging, particularly in China. The company has taken decisive steps to up its competitiveness, reduce the cost and improve cash flows while continuing to invest in exciting products and leading edge technologies. With these interventions, we are building Tata Motors Group to deliver strong numbers in the medium term. Nitesh, what's your first reaction to this JLR quote which is coming in? Things continue to be still challenging in China?
From what we understand through our checks with dealers of JLR in China, during the quarter, the company had given certain one-time incentives to cover for the historical losses the dealers have been making. So it looks like in this quarter, we would have seen some hit because of one-time incentives the company would have rolled out for dealers in China. We would await clarity on how much is the quantum of incentives, is it one time, and what could be the recurring part of the same. Prima facie, these numbers are pretty disappointing. The street was looking at 11.5% EBITDA margin on JLR, versus which they have reported 7.3%. But we still await how much is the one-time incentive portion which the company would have given to the Chinese dealers.
Hi Nitesh, this is Nantara. You've also got a forex loss of 171 crore rupees. You've got the JLR impairment provision coming in at 27,000 crore rupees. What do you make of this? Is this, because of Brexit, or what is this? Do you have any idea at all?
Yeah, this looks to be because of certain one-time incentives which the company has given to dealers in China. Primarily, it seems to be that. But we would await management commentary as to the specifics of what this belongs to.
But even if you look at the bottom line, if you look at the EBITDA, the margins that have come in, would you say, first cut analysis, it is disappointing, even though the top line seems to be in line with estimates?
Yes, certainly. Margins are disappointing. I think even the lowest estimates on the street was somewhere about 10.5% EBITDA margin, and versus that, the reported margins are way too weaker than what street was expecting.
A quick question for our viewers. The impairment which has happened has of course happened over a period of years. They acquired the company in 2008 for great valuations, and now of course the value of asset is not that high, and that's why they are forced to impair. But that should be treated as a one-off, right? And it doesn't impact the cash flows as well.
Yes, it would be treated as one-off.
And it doesn't impact the cash flows as well.
Yes, certainly.
Right. Karunya is now with us. Karunya, what's your first take analysis?
Yes, Pankaj, hi. First cut, the numbers are looking very disappointing. Look at the margins on a consolidated basis, single digit, 7.9. It's not even high single digit, it's mid single digit. They've given a loss not of 2,000 crore rupees, but a loss of 26,000 crore rupees. But yes, what we are sensing is once you read the entire press release, they've given an impairment provision of 27,838 crore rupees. So that is a huge chunk. That is a one-time impairment that the company has borne this time around, because of which the consolidated profits and even the margin performance overall has gone massively tumbling down, and that's something that I would like to also address with our experts who are with us on the show right now. Bharat, after this impairment provision, 27,800 crore rupees has been provisioned. Can we expect the burden on the company to lift going forward? Is the worst over, likely to be over?
We have to wait for the management commentary as to what is the nature of the impairment. Prima facie, it looks like a one-time non-cash charge. But the main area is that the operating performance continues to remain weak for a considerable period of time, and even for this quarter, the margins have been fairly below what the street was expecting. So a lot of challenges and uncertainties continue to remain. We'll have to see how this will help.
Okay. Let me also go to Nitesh. Nitesh, the company has said that the JLR impairment provision mainly because of what is going on in the China market, the kind of immensely massive slowdown that the market has seemed to have hit, and of course the margin guidance for the full year is also likely to be EBIT margin guidance for the full year is likely to be also in the negative. This is something that the company has said. So can we expect that even going forward they are also factoring in some amount of stress with respect to JLR? JLR is still continuing to sort of shake the entire financial situation, the P&L statement of the consolidated numbers. JLR will continue to weigh heavy?
Yes, certainly. If you see, the company has been struggling in China from the last 4 or 5 quarters. The main reason for the same has been the retails have been weaker and the dealers have been flushed with inventory. So during our last checks, we understand that until last quarter, the dealers were choked with up to 2 months of inventory versus the regular 1 month average the industry maintains, which was hampering dealer profitability, and hence the motivation of dealers to sell JLR products was pretty low in China. Which began to create a loop cycle wherein the dealers were not motivated, the products were getting aged, and the CJLR, which is their Chinese joint venture, were facing some quality related issues. All these things put together meant that not only volumes but margins had to be under pressure, and this quarter clearly reflects the same. We think that company has taken a lot of steps recently to improve their performance, but I think that it would take some time before the fruits of the same could be reaped. So coming to the outlook for the next couple of quarters, maybe the Chinese performance could remain sluggish, and post which we could see some improvement coming through in China, which would reflect in the JLR numbers.
Right. Nitesh, just be on hold. Mahantesh is also joining us right now. Mahantesh, talk to us about what is going on in JLR. There have been immense, very significant steps taken by the company to control costs, to turn profitable, turn around the entire stress on the business. But these initiatives, as of now, have not started showing in. The management, however, seems to repeatedly say that they will turn around, over the next few quarters. But given the kind of performance and given the kind of deep stress the company is in and the kind of headwinds it's facing, China, Brexit, US slowdown, do you think they will be able to pull this off any time in the next 1.5 years?
It's very difficult to predict whether they will be able to pull off a decent turnaround in JLR given these headwinds that you've just mentioned. So right now, what they seem to be doing is they've been going through a balance sheet kind of restructuring. Couple of quarters back, if you remember, they had gone into accelerated depreciation kind of mode. Now they seem to have changed their mind and they have taken an asset impairment of almost 3.1 billion pounds. So these are balance sheet measures. These are not necessarily business turnaround measures. So financial re-engineering is not what analysts are looking at. They really want a business turnaround for this company. So like I said, seems very difficult given the headwinds to turn around the business in a matter of 1 or 1.5 years.
Right. Mahantesh, I clearly remember the 2008 report which you had written on the JLR acquisition. And finally, they have taken an impairment. You had pointed out about the goodwill, the sort of deferred tax liability that the company is taking in. Finally, all of it has been written off now?
I don't know whether finally everything has been written off. See, the whole point is that JLR has been spending massively on capex, okay, and whatever they've been spending on capex, some portion of it has been written off through the P&L mechanism, but a substantial portion is being accumulated or was getting accumulated on the balance sheet, building up the not necessarily the goodwill, but the intangible asset side. How much of that intangible asset was really worthwhile remains to be seen. So if they've taken a 3.1 billion pound impairment, it clearly suggests that all that impairment, all that intangible assets they've been building over the last decade or so is not yielding useful gains. Probably there is more left in terms of impairment of assets as they relook at the businesses once again. So I don't think this is the last word on impairment that we have heard so far.
Okay, Mahantesh, given the kind of numbers they've delivered, it's a bit of a rather massive shocker for the markets. I don't know how the investor community is going to be taking it and digesting it. But going into the con call, what will be some factors that one needs to understand and closely watch out for with regard to management commentary? What would you watch out for?
So there are two things. One is on the margins of the business. The two businesses that they run, one is the India business and the other is the JLR business. So that's point number one. And point number two is when are they going to be really free cash flow positive? Because both the businesses are running or consuming cash. There's no free cash flow getting generated. And at this pace, it appears that the company's debt will keep ballooning going forward and may not be sustainable. So for investors, its margins and sustainable debt ahead or free cash flow generation is of importance to really understand from the management how are they going to tackle both these issues.
Okay. All right. Is Nitesh also with us? Nitesh,
yes.
Just coming to you as well, how are you likely to analyze this, the kind of performance they've delivered? More pain ahead, because Mahantesh clearly thinks that it is a bit of a dicey situation right now with respect to what JLR's, whether the impairment situation is now over and done with, or if there is more in the future. What is your view?
Yeah, certainly. I think the view is largely similar as to the company has been investing large amounts in various kind of capex. So they have an annual capex spec at 4.5 odd billion pounds versus their cash flows, which looks like it would be in the territory of 3.5 odd billion, 3 to 3.5 billion pounds. So the commentary surrounding how the cash flow management would happen, how the margins will shape up going forward. Was there any one-off relating to, one-time incentives which the company might have given to the dealers to boost their motivation? So these will be the key questions we would look out to ask the management, and then shape our view where the company is moving going forward.
Before I let you go, just one thing very quickly, this impairment issue. How does a layman, an investor, read into it? Does it have any... Okay, Mahantesh, I think we seem to have... Mahantesh, just a quick question before we let you go. If we talk about the impairment aspect, Hindalco has also taken it in the past. How should an investor read into it? Is it just a technical sort of an aspect, or could it have a very big impact going forward as well? Just to give some perspective from a layperson's point of view for the benefit of our viewers.
So for a financial re-engineering that takes place in terms of impairment actually cleans up the balance sheet. And if you read through the press release of Tata Motors, they've also mentioned that this impairment would lead to lower depreciation costs per annum of the order of 300 million pounds. So definitely the P&L therefore going forward looks better because the depreciation charge will be lesser. So for a layman, this is a pointer that the future profits and losses that they will be reporting will at least be lightened to the extent of 300 million pounds per annum. Okay. Otherwise, it's a technical, it's a technical adjustment or a financial re-engineering, as I call it.
Mahantesh, Bharat, as well as Nitesh, all three of you, thank you so much for helping us understand what it means for the company, the kind of numbers they've delivered and the likely way forward. And of course, we'll be keeping you posted about what the management has said in the guidance on the con call.
Thanks so much for that, Karunya. Those are